Hey everyone, it's Ankit Patel. Welcome to a brand new video today. Today I want to do a quick video on a couple of signs that you might be looking for when you're trying to consider when the market's going to crash, or when you think it's going to crash. You want some facts and some proof behind it. I have a couple of signs and indicators and information that might help you with that, determine if the market's going to crash anytime soon or later. Do you think the stock market will crash soon? If so, why and when? Let me know in the comments below what you think and what your opinions are. If you're brand new to this channel, please subscribe and hit the like button, and in the comments below let me know when you think the market's going to crash and why you think it's going to crash. I'm curious on what your thoughts and opinions are. Also, let's try to hit 6,000 subscribers on this channel. And with all that out of the way, let's get into today's video about some good indicators and some good signs that determine if the market's going to crash or not, and how we can use these signs. Market crash prediction from Robert Kiyosaki, Elliott Wave International, for October 2021. In headline grabbing quote, he also stated, "It's going to be the biggest crash in the world history." Biggest crash in world history. Personal finance expert Robert Kiyosaki predicts economic crisis in October. A crash is really good time to get rich. This is going to be the biggest crash in world history. We never had this much debt pumped up. The debt to GDP ratio is out of sight. The stock market was being artificially inflated by the Treasury Department and the Federal Reserve, with decision disconnected from the realities of the current economy in the United States. So they pumped all this money, prices go up. So it is a transitory inflation, but we stacked with this a massive debt, and all this is done is bump up the stock price and real estate market. The money has gone into the economy. That's the sad part. So the rich get richer, the poor and the middle class are getting poorer. It's tragic what's happening today. Giant stock market crash coming October. Why? Treasury and Fed short of T-bills. Gold, silver, Bitcoin may crash too. Cash best for picking up bargains after crash. Not selling gold, silver, Bitcoin yet. Have lots of cash for life and aftershock. Market crash. Stocks dangerous. Be careful.
On this October crash, Secretary Yellen is warning that if Congress doesn't raise the debt limit by October 18th, that there'll be a financial crisis, a calamity, as she calls it. Is this what you think will trigger this October crash?
Well, I think it's already been triggered personally, because after I posted that market crash, the S&P 500 is really the S&P 7. And it's being held up by Treasury Secretary Yellen and Powell. So there's no correlation between the economy and what Yellen and Powell are doing. Now, I say one more thing, is that I'm a little strange in that I like crashes. So this next crash is going to be really, really good, but it'll bring down gold, silver, Bitcoin, stocks. But the good news is a crash is a good time to get rich. So that's why I'm optimistic, and I'm very optimistic on gold, silver, and Bitcoin, not on stocks. The debt to GDP is a correlation of M2, the volume of money, times the velocity of money.
Right.
And the reason Yellen and Powell are scrambling is because they've expanded M2, so everybody thinks there's going to be inflation. But velocity of money, which is what Jim Records and I always talk about, the velocity of money is plummeting. People are not spending. So they pump all this money in, prices go up. Meanwhile, the Asians are catching up now. The ports are finally open. So it is transitory inflation. But the problem is we're stacked with this massive debt, and all it's done is bump up the stock market and real estate market. The money has not gone into the economy. I don't know what it'll exactly be, but you can't keep printing fake money. That's M2. And the velocity of money keeps dropping, but the debt keeps going up. So you and I don't have to go to, it was $350 an ounce. You see, every professional investor knows it's not when you sell, it's when you buy. So I bought Bitcoin at 6,000 and 7,000. So I'm just saying, I'm a pure capitalist. When markets crash, it's the best time to get rich. We have not reinvested. The Fed and the Treasury have only invested in the investor class. They haven't invested in the working class. And the working class is without jobs, without pay, without this. Their 401ks are going to get toasted. And that's why I'm more saying, I don't like what's happening.
A 48-year market vet warns that investors should prepare for a more wealth destruction than we have ever seen, as the Fed gets set to tighten policy and says the stocks will crash 80%. Do you think the stocks will crash 80% or more? I think there's been a lot of signs and a lot of stuff going on, so we'll see what happens. David Hunter reiterated his calls for a steep decline in stocks ahead. He said he expects the S&P to drop as much as 80% from its peak. Hunter said the Fed is tapering would trigger the crash. Stocks are up 90% from the lows in the last year and a half, an extraordinary bull run. Many measures of valuation show historic overextension. The Federal Reserve is getting set to taper asset purchases. Treasury bond yields are expected to rise. The pandemic isn't quite under control yet. Chinese real estate firm Evergrande near collapse sent shockwaves throughout the global financial system. The list goes on from what's going on all around the whole world and the US. Federal Reserve begins to cut back its balance sheets and taper its asset purchase, Hunter said, and he expects the pullback to be big, up to 80% peak through. We're going to see more wealth destruction next year, I think, once we get past this last move than we have ever seen. Taking this liquidity away could very well trigger a downturn. The Federal Reserve's balance sheet has expanded and contracted over time. Here's the chart right here. 14 warning signs that the stock market is crashing. 14 warning signs that a stock market crash is coming or inbound. Let's get it right into it. 1. Prolonged dovish monetary policies. And they currently lowered the rate for mortgages and everything. However, prolonged low rates can be a very bad sign because they can't last forever. At some point, debt will have to slow and rates will have to increase, resulting in tightening of consumer spending, and if the contraction is significant, a stock market crash, which right now we have seen a significant low interest rates, bond buying, propping up the market. It has just been ridiculous. The valuations of all these companies have been through the roof. The United States Federal Reserve Bank, also called the Fed, is the central bank of the U.S., meaning that the bank is charging without determining monetary policies for the U.S. So considering the stock market as its core is nothing but a system that allows for the movement and balance of cash and value, the Fed plays a crucial role in the market activity. The Fed's fund rates. So the Fed has recently been buying up bonds, propping up the market. Number two could be a bubble in the market's valuation. Like we had the dot-com bubble, we had the real estate bubble, and then we had the you-know-what bubble about a couple of months ago. So what's going to be next? What bubble do you think we're going to be in next? I'm curious. Let me know in the comments below. Number three, if you have an extended bull market, which, you know, we're in right now. Everything's just going up based not on evaluation or, you know, supply and demand. It's just going up because the Fed's, you know, propping up the market. A clear sign that the market crash is coming is when profits begin to hit a flat. Investors are only happy when companies they invest in are growing and making profits. If profit stops growing, it raises the question about the company's ability to continue going ahead, leading many of investors to abandon the ship and driving the stock prices down. During times of economic uncertainty, when consumers' confidence is lacking the most, consumer spending often dries up, leading to plateaus in profitability for many businesses and widespread stock sell-offs. So right now we have really high unemployment numbers. I don't believe the unemployment numbers that are coming out are accurate. I think it's way higher. And number 4 on the list is corporate profits turn into flat. One of the key drivers for the stock market is profitability. And for good reason. Nobody wants to invest in a company that's losing money with no sign of profitability ahead. But right now everyone's just throwing money at all these stocks, and I'm looking at these stocks that they're buying. Some of them are not even profitable. You have a company like Chewy, which people are saying, oh, this is a great buy, but the company's not even profitable. Like, makes no sense to me. Value investors use the PE ratio, like I said earlier, or if I might not have said, I don't know. But the PE ratio, price to earnings, is if it's too high right now, that means it's not a good stock you should be getting into right now. Everything is overvalued right now in the stock market. And a company's profit helps determine the fair price of its stock. And right now you're not going to find discounts. And if you do, there's only like a few in the stock market right now. So that's why I haven't invested, because I want to see what the Fed's going to do, and then I'm going to react, and then I'm going to do. And right now I don't feel like there's fear in the stock market. There's no fear. People are just buying. Right now we have a lot of people that are unemployed, that are probably living off the stimulus checks and probably making more from the stimulus checks than going to a job. We had the most job openings right now. If you look on Glassdoor or LinkedIn or anything, not many people are applying to these jobs, so competition's not that much. And not many people want to work right now. There's no motivation. The government keeps the government and the Fed and everyone with all this money printing keeps bailing everyone out. So you also have people who are not paying their mortgages or delaying the payments because the government's like, oh, it's okay, don't worry about it right now. We understand what's, because of the situation that you can't pay it, so we're going to help you and we're going to bail you out. So the government's pretty much bailing everyone out, and the Fed's propping up the market. So right now, and also people are not spending money, the prices of everything gone up. So the people that are actually spending money are the people that are actually making money and have a nice job and nice salary. But they also don't mind overpaying for items and cars and houses and everything. So it's, sometimes they need whatever it is, the house or the car. So they have no choice other than to buy it. So the market is thought to be a balanced system, but the reality is that it's anything but balanced. From day to day, month to month, and even year to year, the stock market struggles to keep valuations in check as bears and bulls argue their points. And you can see this on Wall Street Bets. You can see this on a lot of YouTube channels. You can see this on, if you're on Webull, you can see in the comment sections, people are going to argue, no, this stock shouldn't be worth that much. No, the stock is overvalued. And it's just funny because a lot of times they don't provide facts or support it with data, or why is the stock overvalued? Why is it not worth buying? So it's always good, to do your own research and find out for yourself as well, so you can be knowledgeable and understand what's going on in the world. Anytime that the bulls take control for too long, the prices investors pay to own stocks go through the roof, as you can see lately. On the other side of the coin, too much control by bears send the stock market or send the stock prices tumbling, resulting in extreme undervaluations. Look at the amount of time the trend in the market has been upwards. According to Forbes, the average bull market lasts for about 2 years and 7 months. An uninterrupted run of the bulls that lasts considerably longer could be a sign that we're due for a reversal. Too much of a good thing can be bad, so just be careful. Cutting federal unemployment benefits early has not led to a significant greater job growth, as some would expect. I didn't expect it either, Why would people want to go back to work after they've been getting $300 weekly benefits, or even more depending on where people live? The market is right now to be spooked by rising bond yields. Shares are in trouble if the sharp rise in yields since last week's Federal Reserve meeting is starting of a trend. U.S. Treasury yields, 30 years and 10 years. What bothers me is that the rise in bond yields that trigger the fall was really quite small, and there could be easily a lot more to come. In the long run, it would mean bonds would no longer provide a cushion when stock prices drop, making portfolios more volatile. In the short term, if the sharp rise in yields since the Federal Reserve meeting last week is the start of a trend, then shares are in trouble. Bonds don't have your back. Bond yields and stock mostly rose and fell together after 2000, but not recently. Value wins as bond yields rise. Dow Jones U.S. Thematic Market Neutral Value Index changed this year. Fed meeting, it spiked up after it.